First and foremost, let me just welcome each and every single one of you into the chat. So there's quite a few of you guys in already. Thank you very much, all of you, for joining this evening. I really do appreciate you all jumping in. And for those of you catching this as a recording on YouTube, thank you very much for tuning in. I do appreciate it. And if we talk a little bit about equity, and one of the things I always used to do in our events, we did events for probably 5, 6, 7 years. We run events all over the world, spoke on stages in 28 different countries, literally trained tens of thousands of people on how to invest in property. And one of the greatest, honestly, one of my most enjoyable subjects was the aha moment when you realized when somebody went from a moment of understanding that they have equity in their house and they could use that equity in their house or their portfolio and technically create their financial freedom. So be in a position where technically they could retire with the amount of equity they've built up and paid off, so to speak, over the years. For me, that was an exciting moment and a brilliant moment. So I'm sure we're going to have a couple of you guys on this evening where you're going to go, actually, you know what, this is brilliant, or catching this recording, you're going to go, this is brilliant. Absolute gem of information. So hopefully you guys enjoy it. And it's good to see so many new names again, which is awesome. So thank you for all of you new guys who are tuning in live to this evening. I hope you guys enjoy the session. So let me go through explaining a little bit on what equity is first. Once I explain what equity is, I'll talk a little bit about how you can apply that equity to building and growing your portfolio and creating your financial freedom or financial wealth. There's actually a couple of people on here who are doing exactly that, which is fantastic to see. So thank you for you guys for tuning in. We've got a lot of old mentorship clients joined in this evening as well, which is excellent. So thank you very much, guys. So let me explain what equity is. So what I'm going to do is I'm going to be flipping between screen sharing and my iPad. So if I stop sharing the screen, then you guys can hopefully see the iPad behind me. So your equity is basically, if you look at what your house is in terms of the value of your property. Okay, excuse the terrible handwriting. My mother always said I should have been a doctor. So excuse the terrible handwriting. So the difference between the value of your property and the mortgage. Okay, the difference in between there is what we call your equity. Okay, so as an example, if the value of your house is 200,000, okay, and the mortgage on the house is 100,000, the equity in this instance would be 100,000. Okay, so that is technically what we call your equity. Now, this doesn't just apply for your own home, this also applies for any of your investments. So if you own multiple properties, those properties will also be deemed as your investments, and you will also have your equity on those properties. So let me just switch back to sharing screen so you guys can see the presentation behind me. Okay, so that is technically what your equity is. Now, when it comes to creating your success or understanding what you need to do to be able to take yourself from where you are today to your financial independence, or to creating an income that sustains your life or at least supplements your life to make your life a little bit more comfortable, a little bit better, what you need to do is you need to understand 2 bits of information. So we've gone through this on many of the previous webinars as well. So there's 2 bits of information you need. So like when you plot any route on a map, first thing you need to understand is where you are. Okay, so what is your current position? So your equity and your savings, etc., that is part of where you are. So it's understanding your current financial position. And then the other thing you need to understand is where you're going to. Okay, so what your plan is, what you're looking to achieve, you know, what your financial figure is, what your cash flow figure is, whatever figure it is you're looking for. You know, if you want to earn enough money to be able to go on holiday for free every year, if you want to earn enough money to be able to pay for a new Tesla, whatever that figure is, to be able to understand where you are and where you want to get to, that's the figure you need to understand, or the 2 figures you need to understand. So that is equity, sort of explained in a little bit of a nutshell. Okay, next thing. Okay, this for me is very important. So to be able to understand how you can utilize that equity, you need to understand what you can achieve with your investments. Okay, what you can achieve with your investments. So I'm going to switch screen to screen, and then I'm going to go through the numbers with you guys so you can see them clear as day, which will hopefully make it a bit easier. By the way, if you guys have any questions on the live webinar, please do note it. You've got a Q&A section. I think you've also got a chat section. I'm not sure if the chat section is working, but you should be able to put a remark in there, and I'm more than happy to answer any questions you guys have live throughout the presentation. If you're catching this as a YouTube clip, just post whatever question you have. I do answer those questions. If you want to grab a chat, obviously do reach out on our socials, and I'm more than happy to grab a chat with you and answer any sort of more in-depth questions on there in a more private setting. Some people prefer that. Okay, so if we talk about your typical numbers in terms of what you can expect. So if you figure, okay, your normal kind of buy-to-let, okay, investment, if you're looking to try and achieve your maximum return on your buy-to-lets, what you want to be doing is you want to be buying houses that are reasonably low value, but reasonably high rent. Okay, and these properties are normally going to be in the north of England. If you're just looking for something that you can go, oh, well, this is local to me, I'm happy with it, it makes a little bit of money, so on and so forth, that's fine. But if you're looking to earn the maximum money you possibly can, you want to be buying something in a lower value but higher rental area, so what we call a high yield area. For those of you that don't know, yield is basically your annual rent divided by the value of your property as a percentage. That then gives you what your yield is. Anything over 8% yield is pretty good as a buy-to-let, just as a standard rule. Okay, so buy-to-let, your typical figures in one of these sort of areas, one of these sort of properties, and we've got a whole bunch on our website. If you haven't already seen, go take a look at trustbricks.co.uk. Go take a look. You'll see some of the properties on there. And what I'm going to do is I'm going to show you a basic property, and then I'm going to show you how you can amplify that to be able to earn more money. Out of interest, let's just check who's on. If you would like to earn more money and you're in the chat, please do give me a yes. If you want to earn some more money, give me a quick yes in the Q&A or the chat. Let's just see if you guys would like to earn some more money. If you would, I'm curious to see how many of you guys want to earn some more. Because yeah, okay, yeah, hey, good. Okay, you guys want to earn some more money, so let me show you how to do that. That's awesome. Thank you very much for being participants. I do appreciate it. And of course, those of you catching us on YouTube, please do chat at all times. Awesome. So we've got some of you guys in chat, some of you guys in Q&A. That won't get confusing at all. So yeah, why not? I like that, Adam. I like your response. Okay, so your typical buy-to-let. If you look, your typical buy-to-let, you're going to be buying as your purchase price. If you're better yield, or so your better returns, where you make the most money, you're going to be buying stuff around the £80,000 mark, so 80K. Okay, that's sort of your sweet spot in terms of where you're at to get your maximum kind of returns. Okay, now with a purchase like that, you're going to end up getting a mortgage on this. So if you're not sure whether a mortgage is a good idea, number one, yes, it is. If you get a decent enough interest rate, it 100% is, because the power of leverage gets you a lot more. Two, if you want to understand how that all works, check out some of our previous videos. We've got a whole bunch on here. We've got a whole bunch on our site, etc. So do check them out. There's a whole bunch of useful info on there for you guys. Okay, so your typical mortgage is going to be 75%. Do not go higher if you can help it. 75% is a good figure. If anything happens to the market, you've got a 25% buffer, which is quite a handy buffer. So in this instance, your 75% would equate to £60,000 or 60K, okay, which means your deposit on this property is going to be circa 20K. So it is essentially the difference between the mortgage and the value of the property. Now you have some other costs to consider. So you've got your stamp duty, your legal fees, any sort of minor refurbs, your brokerage fees, etc. In this instance, we're going to call it other costs. Okay, I can go through to the minutiae of how that looks, and we've got that on some of our other videos. I'm going to go through the principle in this instance, because I want you guys to understand the principle, because once you understand the principle, you can sort of apply all the minute detail numbers. So in this instance, we're going to say other costs of circa 5K. Okay, that'll cover your legals at 2K, your stamp at probably 1,800, and your broker, etc., etc. So we're going to say 5K spend, which means your total spend, okay, so the amount of money you have to spend to buy this property. It's funny, my writing looks so much better on the iPad than it does on the screen. So hopefully it doesn't look so bad for you guys. So your total spend in this instance is your 20K plus your 5K, which means that your total spend in this instance is £25,000 to buy a house. Okay, so that is your typical spend to buy one of these houses. Now, if we look at what that looks like in terms of rental, so if you say your rent on this house, okay, is about $550 a month. Okay, so that's your rent per calendar month. Okay, your mortgage payments in this instance, so we're going to use it at, say, 4%. So you've got a £60,000 mortgage. So £60,000 times by 4% equals, and then you want to divide that by 12, because that's your annual payments. So divide by 12 to give you your monthly payment. So it's £200 a month. So your mortgage is 200 per calendar month. Then your management, so this is your lettings fees, because you do not want to be self-managing. Self-managing is a ball ache. and all you are doing is valuing your time at the same as a lettings agent, which, let's be honest, your time is worth vastly more than that. I'm sure you would take that deal, Adam. I love it. Good man. So your management in this instance is going to be circa 10% of the rents received. So in this instance, it will be £55 per calendar month. And then your operating expenses, often called your MO, monthly operating expenses. So what we're calling is your OPEX here. It's more of an accounting figure, is also accounted for roughly 10% of your rent, which again is £55 per calendar month. Now, if we work that out, you've got your 550 minus your £200 a month in mortgage, minus your 55, minus your 55, gives you £240 per calendar month. Okay, so what we call this is your cash flow for one property. So basically, for you investing £25,000, you're making £240 a month, which, if you wanted to work that out per year, equates to £2,880. Okay, so £2,880, which basically means you're earning more than 10% of your original investment back per year on this property. Okay, so that is your typical buy-to-let figures, just for a little bit of understanding for you guys, which I think is always very useful. So let me just switch back out into the share screen. So I'm going to be doing a lot of back and forth, so we're going to run through a lot of calculations with you guys today. If there is anything you are unsure of in the calculations, whether you're watching this as a recording or whether you're watching this live, do drop us a note. I'm more than happy to go through this privately with you. This, for me, it's fundamental. This is the fundamentals of understanding how to be able to create your financial freedom through property, which is really cool. Okay, so now there's a couple of things that you can do to be able to increase your returns, okay, to be able to make more money, which for me is brilliant. So let's just say in this instance, you're buying the house for a bit of a discount, okay? And what we're going to do is we're going to say you're buying the house in this instance for a 20% discount as an example. Okay, and we've got lots of properties on the site that you can get a 20% discount on. So your purchase price, so your PP, your purchase price in this house, in this instance is going to be 60K. Okay, so you're buying it for 60,000. You know, you get a mortgage of 45,000, and then you've got your deposit of 15,000, and your other costs, so the same other costs at 5,000. Again, I'm just doing some rounding, so I want you to get the principle, which means in this instance, you're spending 20K to buy the house, just as a basic example, right? So you guys sort of understand exactly how this works. Now, this is where it gets interesting, because what you do is you buy the house either on a mortgage, or you buy it on a bridge, or you buy it for cash, or whatever it is. It's irrespective. Whatever the cost of your finance is, you account for that in your other costs. So if you're buying a bridge, obviously you account for that in there. But let's just say the value of this property. Oh, come on. There we go. So the value of this property is 80K. Okay, so you're buying this house. It's actually worth £80,000, but you're only buying it for 60,000 because you managed to get a little bit of a discount. Always a winner. Everyone loves a discount. And obviously we like to do discounts. We do quite a few. So absolutely worth a little bit of a look. So you're buying, so you've got a value of 80,000. And now, right, you've got a mortgage at 60K. Okay, so they're now giving you a mortgage of £60,000. So the difference between 60,000 and 45,000 is £15,000. Okay, so you've got a £15,000 difference. But of course, you're going to have legal fees and other sort of costs, you know, like brokerage fees, etc. So you want to account for those at 3K. So the amount of money you will release. So if you get a mortgage, so you've got a mortgage of 45,000, you then refinance the house. So it's now gone up in value. You get another mortgage. They go, okay, we're going to give you 60,000, but you have to pay off your original 45,000. That leaves you 15,000. Then you've got your legal fees and your brokerage fees, etc. Let's call that 3,000. So that means you're going to end up netting £12,000. Okay, 12K. So that's how much you net. So had you bought the very same property over here, okay, had you bought this very same property for a discount and then refinanced the property at the £80,000, your money left invested, okay, would be less £12,000. So in this instance, the amount of money you've got invested in this house is only £13,000. So if you started with a pot of £100,000, instead of only being able to buy 4 houses because each house costs you 25,000, how many houses could you buy with 13,000 per house? Okay, now I'm not saying you'd be able to buy them all at once, but the point is you'd be able to buy them over time. So you go 100,000 divided by 13,000 means you could buy 7 houses. Okay, so that is equals to 7. So the question is, who would prefer to own 7 houses over owning 4 houses with the very same pot of money and being able to earn the same amount per house, but earning 7 houses worth rather than only 4 houses worth? And the answer is all of you, right? You'd be mental to say, actually, I only want 4 houses. It's fine. I don't want 7. I don't want to make more money. I prefer not making more money. Okay, so this is how you can sort of amplify the amount of money you're making. Okay, and this for me is where it starts to get a little bit more interesting. So if you're buying stuff for a discount, once you refinance that property, the amount of money you've got invested in it is much lower, but your rental income is the same. So that means you're making more money on the amount of money you've got invested. Okay, which is what we term the ROI, the return on investment. So you're making a higher return for the same amount of money. If this isn't clear for whatever reason, please do let me know. I'm more than happy to sort of go through it again. We've got a whole bunch of videos on the stuff anyway, but I'm more than happy to check it out and go through it with you guys personally as well. Okay, and yes, Adam, I would take that deal too. It is a good deal like that. Okay. So that's the general gist of being able to buy a house for a discount. That means you can make more money for your money. So if you start with 100K, you can end up with 7 houses instead of only 4 houses, which means, oh, I should have switched this out. Sorry, my apologies. Which means, okay, if you figure you're making 240 per house, so it means instead of having 4 houses at 240, okay, it means you have 7 houses at 240. Which means instead of only earning, what's that, 960, oh, I can't do 7. I'm good, but I'm not that good. So 7 times 240 is 1680. So 1,680 pounds per month. Okay, per month. That's every single month, forever and ever and a day. Okay, it actually goes up, which we'll go through in just a minute with you guys. So out of interest, what would you prefer to earn? Would you prefer to be earning 960, or would you prefer to be earning 1,680? Okay, which is almost double, not quite double, but almost double. So all for just essentially just boxing a little bit smarter and getting something at a little bit of a discount, whether that's 10, 15, 20% discount. The bigger the discount, the better, but don't get bogged down on going crazy for discounts, because providing you're buying stuff at a discount, it just means you're going to make more money. Okay, if you're trying to wait for the perfect deal with the best possible discount, you're going to be waiting forever, and the opportunity cost, you'd be losing your money every single month that you haven't taken action. So the point is, keep moving, buying stuff, get the discounts you can get, and keep on moving, keep buying. Okay, I thought that'd be really cool for you guys to see. So let me switch back out. Like I say, I'm going to be switching back and forth quite a bit. Okay, so the next thing is understanding what your releasable equity is. So how much releasable equity have you got in your existing portfolio, and what is the cost of that money? Okay, and the important thing is understanding cost of money. Cost of money is a term that you need to become very familiar with. If you want to get into the space, get into the investing world, and get into the investing mindset and understanding what you're doing, cost of money is an extremely important term. So cost of money and return on money are the 2 most important things you need to bear in mind. Providing your cost of money is lower than your return on money, you're always in profit. If your cost of money is more expensive than your return, you're losing money, and it means you're making no sense in what you're doing. Stop doing it, do something else. Okay, so let's switch it out and we'll look at what releasable equity is, just so you guys have some clarity on that for anyone who doesn't. Okay, so let's just say you have your house, and excuse my house drawing. Fortunately, I'm not a structural surveyor because my pictures would be terrible. Okay, so you have your house, your home, and your house is worth, let's just say it's worth 400, or so let's say it's worth 500,000 pounds. So 500K. Okay, and you've been a good little citizen and you've been paying off your mortgage religiously for the last 15, 20 years, you know, and you bought the house for 200,000, it's now worth 500,000, you've been paying off your mortgage every month, and your mortgage, okay, at this point is only 50,000 pounds. Okay, And this happens a lot. I have a lot of clients that are in this kind of position where they go, yeah, I've been paying off my mortgage. I've almost paid off my mortgage. I'm really excited. I've almost paid it off. And I'm going, it is a waste. It makes no sense whatsoever to have that mortgage fully paid off, because all you are doing is you are not leveraging the profitability or the ability to be able to make money. Okay, and you'll understand exactly what I'm saying in just a minute. This is pretty cool stuff. So hopefully you enjoy this as much as I do. So you can leverage your own home or an investment property, you know, typically 75, 80, 85, even 90% on your own home. My suggestion is go up to 75% lending. Okay, that's what you're after, 75% lending. Okay, you don't want to really be lending more than that. So 75% of 500,000, so you go 500,000 times 0.75 is 375,000. So you can leverage up to £375,000. Now you've already got a mortgage of 50,000, so you have to knock that off. Okay, because that is not, you're not going to be able to take money out that you already have as a mortgage. You can only take out the difference between the 375,000 and the 50,000. So you minus your 50K, okay, which means you're left with £325,000 that you can actually withdraw on your mortgage. This is the amount of money you can pull out of your property, whether this is your home, an investment property, whatever, it doesn't matter. We've got a whole bunch of clients that have done this to huge success, and you'll understand exactly why in just a minute. Okay, now that 325,000 will have a cost. Okay, it's going to cost you money to have that money out. Now, fortunately, homeowner mortgages are not that expensive. You're talking 3-4%, whatever it is, often below base, because what they're doing is they're busy offsetting with your product fees. Okay, but let's just say, you know, worst case scenario, you're at 4%. Okay, so let's just say this is a 4% mortgage. That's how much this money is costing you, 4% on your money. Okay, which means your 325,000 times by 4%, okay, is 13,000 divided by 12. So that money is costing you £1,084. Okay, so 1,084 per calendar month. So that's the difference. Obviously, you'll have had a cost for the 50,000, but that was there anyway. I'm just showing you what the difference is. So your 325,000, if you were to refinance, would be costing you £1,084 a month. Now, this is where it starts to get really interesting. Okay, so you've got two avenues. You could just buy stuff at market value. So you just buy your £80,000 house. It costs you £25,000 per house. You're just buying it good to go, no stress, no hassle, just rented it out. Okay, now with £325,000, you go 325,000 divided by 25,000. You go, well, you can buy 13 houses of this. And I'm going to keep this really simple. We're not going to do the discounted model. We're not going to be buying for discount and stuff. Just know you buy for discount, you will make more money. Okay, but let's just go really, really simple. So you're buying a normal house, no mortgage, no big discount, nothing crazy. So you got your house. Okay, it costs you, you know, its purchase price is 80K. Your deposit is 20K. Your other costs is 5K. So you're in for 25K. Okay, so you're in for £25,000 here. But now you start with a pot of 325K, which means you can buy 13 of these. Okay, so basically what we want to do is times these by 13. So you go, okay, well, you've got 80,000 times by 13 gives you 1.04 million. Okay, so 1.04 million. Okay, that's your purchase of the entire portfolio. Okay, and then you've got mortgages of 60,000 times by 13, so 780,000 in mortgages. Okay, now this might scare some of you guys, but don't worry, the amount of equity you've got is reasonably similar to what you already had. The difference is you've got a lot more income, which is more secure than having equity. I promise you, because you can't go check in equity anytime you need to go get some cash out or need to pay a bill, but your cash flow, your income, you can. Okay, so your deposits in this instance, or your other costs will be 13 times 5,000. So 13 times 5,000, 65,000. So 65K. Okay, so your total spend is 845. No, so that's mortgage. So, bear with me 1 second. So this is your mortgage amount. So your deposit amount is the difference. So 1,040,000 times 0.25 times 0.25. 260,000. That's better. So your deposit is 260K. Okay, and your other cost is 35K, which means your total spend in this instance is 295K. Kind of makes sense, I'm pretty sure. So, yeah. So 20,000 times by 13. Yeah, 260. And then it was 65,000, that's why. Okay, so that's 325,000. Okay, so that is your total spend, right? So your 325,000, which is the very same 325,000 you managed to pull out right at the beginning. So now you're in a position where you own 13 buy-to-let, so 13 houses. Nothing crazy, nothing untoward. We've got a whole bunch of our clients that own more properties than this, and they've done it all through essentially doing exactly what I'm busy showing you here. Now, where this gets really interesting is if you go, okay, well, each one of these houses, if I go all the way back, so each one of these houses makes you £240 per month. Okay, so that's how much you're making. So if we go, okay, so now at this point, you go 240, let me get out of the way, times by 13 houses. Okay, so 240 times by 13 is equals to 240 times by 13, 3,120. So you go, okay, so now you're making 3,120 pounds per calendar month. So this is a net figure. This is after accounting for maintenance costs, insurance costs, any void periods with the tenancy, everything. It is net. The only thing this is not net of is taxes. And if you're smart and have a good accountant, you can minimize those to next to nothing. Okay. So 3,120 a month. Now, bear in mind, there was a cost for this money. So this 325,000 was not free. Okay. This money cost you to be able to get, and it cost you by way of mortgage, right? So of course you've got your mortgage here and it costs you £1,084 per month. So of course you've got to deduct your £1,084 per calendar month, which leaves you a net figure. So minus 1,084, leaves you a net figure of £2,036. Now what this means is even after all mortgage payments, all bills, all that sort of stuff on the portfolio of the lending of everything, you are £2,000 a year better off. Now, what that relates to is a new pay rise of £24,500. Okay, so that is 24K per annum. Out of interest, who'd like a pay rise of 24,000 a year and you don't have to do any work for it? Who'd like that? Okay, it's going to be a lot of you guys, right? This is crazy stuff. So I love this. And I always get people go, oh, that can't be true. If this was true, then everyone would be doing it. And I'm like, it is true and everyone should be doing it, but they're not because they're too bloody scared. So the same reason you're going, oh, I don't know if this is true, I don't know if this works, etc., is the very reason why you're not doing it. This works. I know this works because we've delivered somewhere around 680, 690 properties to our clients. We've created financial freedom for at least 20, 30 people doing exactly this model, having mentored tons of people over the years. So this works, 100% it works. Very, very interesting and well worth taking a look. Okay. Now, let me show you next level on this. Okay. So next level on this. Okay. You then use that equity to build or grow your income exactly as I've just shown you there. But, and this is the thing that's really interesting. So this is the thing that people tend to miss. Now, many of you guys know we're a data company, right? So what we've done is we've taken over 20 years worth of market data, looked across the board, every single property sold across the board, over 1 million properties sold in 2001, 960,000 and over 1 million sold in 2021, give or take. And what we've done is we've applied and said, okay, well, what is the price difference across the areas? And we take a look at the uncompounded figure or decompounded, whatever the term is, figure to be able to find out what percentage of the property value growth is within these price brackets. The really interesting thing is the average property growth, okay, average property growth in these sort of price brackets is somewhere around 5% a year over the last 20 years. And historically, actually, it's always been around 5%. Now you have your ups and downs, your 2008s and then 2009s, all of these sort of things, you have your ups and downs, but as an average over that time, 5% a year, okay, growth, which is really interesting. The other thing is your rents typically go up by 5% a year as well. You may or may not know this. For those of you that are renting will go, yeah, that's about right. For those of you that are landlords, you go, yeah, that's about right. For those of you that own your own home, you may not realize it. Rents are going up like crazy, 5% a year. Now, what I'm going to do is I'm going to show you how this applies, which for me is freaking awesome. Okay, so what we do is you go, okay, well, now you have your portfolio here. Okay, so you know your portfolio value. Okay, I'm going to move right out the way here because I've got quite a bit to cover in terms of information to show. So your portfolio value is 1,040 million. It's your portfolio value. Your mortgage, okay, if you remember, 780,000. So 780K. Okay, your equity, so this is the difference between the two, okay, in this instance, 260,000. So 260K. Okay, interesting, right? The other thing to remember is your rent, and this will all make sense in a second. I guarantee you'll go, that is insane. I need to do this. Why have I not done this before? Why was this not taught in school? So on and so forth. I guarantee you'll be thinking this because it's absolutely mental. So your gross rent is 3,120. Oh, sorry, my apologies. At 550 times by 13 houses, your gross rent is 7,150. So 7,150 per month. Okay, and then your mortgage payment, okay, if you remember, was, where is it? It was 200 a month. So yeah, 200 a month, we times that by 13, okay, which, if I'm not mistaken, is 2,600. Okay, so you got your 2,600 for your mortgage cost then. Okay, so that's your mortgage. Then you have your management fee. Now your management fee is 10% of your rent. So it would be 715, and then your OPEX, also 10%, 715. And that leaves you a rent of 7,150 minus 2,600 minus 715 minus 715 is equals to 3,120, exactly the figure we went on earlier. So your cash flow in year one is £3,120. Okay, so not a bad position to be in. Now this starts to get really, really interesting. Does mortgage values go up with inflation? No, but property prices do. So you only have 20% or 25% invested in this house, but the entire house goes up by 5%. So you've got what we call a gearing of 4. If you've only got 25% invested, which is 1/4, so you get 4 times the value of your growth. So in this instance, 1.04 million, so you go 1,040,000 times by 105%. So now it becomes 1,092. Okay, so year one, so at the end of year one, it goes up to 1,092. Okay, then the next year, times by 105%, goes to 1,146,600. So 1,147. Okay, so 1,147. So that's year 2, 3, 4, 5. Okay, so I'm just going to do this, and what it will do is I guarantee you'll sit there and go, aha, this is very interesting. So we do it again, times by 105%. So this is year 3, 1,204. Okay, so 1,204,000. Okay, year 4 times by 105%. Okay, 1,264. Okay, it's 1,264. And what about in year 5? So you go times by 105%. So all you're doing is you're adding 5% to the value of the property year on year. So 1,327. Okay, So 1,327. This is where it gets interesting. So if you figure your mortgage value stays the same, so it is 780K here, 780K here, 780K here, 780 here, 780 here. You go, easy enough, no problems. The mortgage has stayed exactly the same. But your equity, so you go 1092 minus 780. So 1092 minus 780, 312,000. Oh. So now you've got 312,000 worth of equity instead of 260. You've gone up by 52,000 in 1 year by doing nothing. So you've basically gained almost 20% on your equity by doing nothing, just owning the property because it's gone up by 5%. Remember what I said? It is 4 times gearing, right? 260,000 times 20%, give or take 22. Okay, and that's what you're seeing here, 312. So 1147 minus 780. Oh, now all of a sudden you're at 367. Okay, 367. Next one, 1204 minus 780, 424. Interesting, right? 1264 minus 780, so 484. And finally, 1327. Oh, come on. 1327 minus 780. 547. Now, over the course of 5 years, the difference is between 547 and 260. So the difference in there is 547 minus 260 means you've made £287,000. Just by owning the properties. You don't have to do anything crazy. You don't have to do anything untoward. You don't have to do any super buying, super discounts, super refurbishments. There's none of that stuff. All you're doing is relying on capital appreciation to increase the value of your money. Okay, you just made £287,000 for your £320,000 investment over the course of 5 years, purely based on the value increase of the properties. Now, I'm not saying 100% guaranteed in 5 years' time you're going to be in this position, but as an average, so over 10 years, at some point in that, you would have averaged out at your 5% growth a year, which means you will be averaging that every 5 years as an average. Now, that's the first bit. And that for me is really cool on its own. So you sit there and go, okay, well, fair enough. I just need to buy a house and own it. And then the value of that property is going to go up, which is freaking great. I'm going to be making a lot of money. And absolutely you will, providing you buy the right house. The other piece to the jigsaw is you need to make sure you buy a house that makes an income. Now, here's where it starts to get really cool. Okay, so I'm just going to put in 287K here, just so we remember it. Okay, but your rents go up by 5% a year as well. So same thing, 1, 2, 3, 4, 5. Oh, that little further, 5. So 7150. So you go 7150 times by 105%. Okay, 7507. Well, I'll go 7506. So let's round. So now your rent is 7,506. Which means your management is going to be £751, give or take, and so is your OPEX, so 751, but your mortgage is still £2,600 a month. Okay, now let's do it again. 7508 should be 7508. Okay, so you got 7508 times by 105%. So next year. So 780 or £7,883. Okay, so 7883, which means that you'll be 788, and we'll do the math all on this in just a second. And you'll very quickly see why this is so powerful, just owning property through time. Okay, times by 105%. Ooh. Damn it. 7883 times by 105%. Okay, 8227. So now you're at 8,227, which means your management is 823. 823 for OPEX, still 2,600 rent, mortgage. Okay, let's go into year 4. So times by 105%, 8691. Okay, so year 4 is 8691. Okay, mortgage payment still 2,600. 10% of 8691 is 869. 869. And then final year times by 105% is 9126. Okay, so year 5 is 9,126. So mortgage costs all 2,600. Okay, nothing changes. The amount of mortgage is the same, so it just stays in position. Now your OPEX and your management is 913. So obviously rounding up, so 913. Right, if we run these numbers, I like this. So 7508 minus 2,600 minus 751. 751 minus 751 is equals to 3406. So now year 2, you're earning £3,406. Okay, so you've just gone up by £300. Okay, the 7883, same thing, 77883 minus your mortgage at 2,600 minus 788 minus 788, 3707. Okay, so 3,707. 8227. It's normally much easier on a spreadsheet. Obviously, 2,600 minus 823 minus 823. So 3981. So 3,981. Okay, 8691 minus 2,600 mortgage minus 869 minus 869. It's 4353. And you'll notice the rents don't go up by the same amount each year. They go up because it compounds. So the main rent compounds, which is very cool. Now, final year, 9126 minus 2,600 in mortgages minus 913 minus 913. So you end up with £4,700 per calendar month. Oh. 4700. And you started, right? You started with 3,120 and you ended at year 5 with 4,700. No properties changed, nothing changed. All you did was move the rent up by the market rent every year. And on top of that, you made £287,000 in terms of growth. Now, where this gets really cool is when you understand how much money you've actually made over the course of 5 years by doing nothing but buying and holding property. Okay. This for me is one of my favorite things. So I'm just checking. If there's any chat, any questions, please do drop them in. I'm more than happy to go over any of this again. This for me is one of my favorite subjects in the world. It's creating financial freedom by essentially refinancing the thing you're living in and renting it out. Okay, so what you do is you go, in terms of your equity gain, so EQ gain, you've made £287,000. Okay, in terms of your rent, or your cash flow. Okay, if you go, you've done 3,120 plus 3,406, 06 plus 3,707 plus 3,707 plus 3,981 plus 4,353 plus 4,700. You've done 23,267. So 23,267. Okay, so basically 23K. So what you've done is you then take your 287K plus your 23K, puts you at £310,000. Now, if your total investment at this point is £325,000, okay, what you do is you go 310,000 thousand divided by 325,000 gives you a return on investment of 95%. So basically, over the course of 5 years, doing nothing special, nothing, no discount, no special properties, no big discounts, no big anything fancy. What you've done is you've doubled your money. You've turned your £325,000 into £635,000 over 5 years by doing nothing, just sat on your property. Technically 6 years, if you want to count it. So this one being year 0, 1, 2, 3, 4, 5. So over the course of 6 years, you've basically doubled your money. Now that, for me, is unbelievable. Okay, because you're not going to get that anywhere else, right? There's no investment vehicle. You can't buy stocks and shares, etc. Unless you're gambling and you're very, very fortunate. There is no surefire way in which you can make that kind of money, that kind of return, purely by just buying some property. Okay, it's unbelievable. So hopefully you guys see the value in that. And this for me is this is why, you know, people always say to me, when should you be buying property? I'm like, when now should you be buying property? The answer is always now. Because if you don't buy it now, if you think about what you were making every single year in terms of capital growth, so I think it was 50,000 in the first year. Okay, had you spent 325,000, you'd make another 50,000 just on growth. So had you not bought that now, you'd be waiting another year and you'd lose out on 50,000 opportunity cost. It's absolutely insane. And the amount of people that go, oh, I wish I did this sooner. I'm like, yeah, do it now then. Like, get it done. This is now the time to be able to get it done. So this is really interesting. Okay. So that being said, if you were to buy something on a discount, you can obviously make significantly more money. So this is just a bit of an example. So this is something we've got in Telford. So Telford's actually just west of Birmingham, out Shropshire way, Shrewsbury way. I think it's Shrewsbury. And yeah, so it's a prime example of exactly the kind of thing we're talking about. So this house, we've been assured that it is rentable condition. It may or may not need circa 5K's worth of work, you know, just to make sure everything's good. From what I understand, there's a tenant in situ, so it is good to go. You're essentially tenanted and you're renting out and you're making money from day one. Now, your yield is higher than what I was showing earlier. And what I was showing earlier was a yield of about 8.5%. This is over 9% in terms of yield. You're buying it for 60,000. It's worth 85,000. This is literally available right now, live on our website right now. So this is, I always find it funny when people go, oh, well, you know, it'd be great if we can find a deal like that. And I'm like, you know, we've got off-market stock that enables you to be able to do exactly that. Like literally this instance, it just comes down to whether you actually want to do that, or whether you want to sit on your laurels and go, maybe I should do that, maybe I shouldn't, and watch all the money roll by. Okay, because all you're going to do is lose money by not taking that step, not taking that action. So this year, Telford, so buying for 60,000 is worth 85,000. So you're getting it for give or take a 30% discount, which is insane. So you'll be renting this out for circa, I think it's $450 a month. Yeah, and you'll be making net returns of over 10% a year, easy at a 4% interest rate. Okay, so you'll be making really good money on this, and there's very little you need to do. We would actually take care of it. So you say to me, yes, I want a deal. We reserve it, we go view it, we cost up all the refurbishment, we bring it back to you and say, is this what you want? And if you say, yes, that's exactly what I want, I'm happy with the refurbishment, excellent, we'll assist you. You move it into legal, you own the property, we don't own anything, it is 100% yours. Once you come through to completion, we'll assist you all the way through the purchase process, connect you with a solicitor or mortgage broker, walk you through the process, give you a guide on everything you need to be able to do to make that happen. Once you come out the other end and you complete and you own the property, we will then refurbish it for you at price, exactly as discussed. And then we will also tenant it for you if you want us to. Obviously, if you want to refurbish yourself or tenant yourself, you're welcome to do it. But we will then tenant it for you if you want us to, and we'll manage it for you. Okay, we'll manage it for you at the interest rates, everything that we're showing on here. So everything is exactly pretty much as you see on there, providing you can get mortgages, etc., based on your own personal circumstances. But you should be in and around this mark. So this is easy money. You're buying this for you're going to make 20K just by buying this stuff at a good discount. Okay, so really, really nice opportunity. So this is the kind of thing that 100%, if you're looking for something that is going to be able to enable you to take your existing equity in your own personal home, or in an existing portfolio, or somebody else's home. You know, it might be mom's home, dad's home, and they want to do this. They want to relinquish some of that for, you know, inheritance early or whatever. This is a really useful way to invest that money safely, sensibly, to be able to grow that money, to be able to grow that into something that is going to give you something more. And for those of you that go, oh, this feels like really high risk, and this comes across a lot. Okay, if it was high risk, why would the term be safe as houses? Okay, it's literally a very common phrase, and you will all have heard it because it is the term. The other thing is, if it was risky, would a bank lend you 75% of the purchase? Now, some of you guys will happily drop $5,000 into stocks and shares, or 5 or 10 grand into crypto, or buying some gold, silver, or whatever else. But the reality is, a bank will not lend you any money to be able to do any of those, because they don't deem them as safe enough. But a bank will lend you 3/4 of the purchase price of one of these, because they know for a fact you're in a growing market that is as secure as it can possibly get. So anybody who goes, oh, well, it's not very safe, they have no clue what safe and sensible and smart investing is. This is very vanilla, right? We're not doing any of the crazy stuff, no HMOs, no big serviced accommodation, nothing crazy, no blocks of apartments or anything. This is pretty much as safe as investing gets. Can I do this while on my first 5-year fixed mortgage? Yes. So Anna, let me and you jump on a call. There is a way to do it. So there is an early redemption, but if we look at the costings, if it makes sense, then it might be worth doing. So let's me and you jump onto a one-to-one call. You can see on our socials and stuff, we'll drop an email to contact@trustbricks, and then one of us will be in touch and organize a one-to-one call. And then I'll walk through with you. It'll be early next week now. I'll walk through with you how that all worked and how that all ties together. And we can essentially get you underway and start to build that nice portfolio for you and create that passive income that you don't have to work for. Okay, this is a really smart, sensible way in which you can build your portfolio, and it's very vanilla. Okay, this is as safe in the property space as you can get. You do not get safer than buy-to-lets. We live in a country where we have 69 million people and 30 million homes. Okay, the typical empty period in a property is 1 week every 3 to 7 years. Okay, so people don't tend to move out of the house, and if they do, it's only empty for a week because there's such a demand, because there's so many people. Non-payment of rent is quite rare, and big damage of the house is rare. It does happen, but it's super rare. And what we do is we account for that with your OPEX money. So your OPEX money covers when that happens, you've got the capital available to be able to deal with it. So honestly, super safe, super sensible. But yeah, head over to our website. You can take a look at a whole bunch of the deals. That's one of the deals we have. That's the deal of the week. I know it's a really exciting one. We don't tend to get them quite at that high level of discount very often. So if you want it, I'd honestly move quickly. I think we've sold something like 38 houses in the last 3 weeks. So, the stuff's going fast, and you'll see on the website, there's a lot of stuff moving. So, make sure if you're interested, do get it reserved. One of the team will be in touch and we can move it forward from there. Please, I ask you guys, if you are catching us either live or on our socials, please go onto our YouTube page and subscribe. Go onto any of our socials that you tend to follow. And please do like and subscribe. I really want to grow this channel so we can reach more people, to be able to enable more people to create their own financial security through their portfolio. There's a lot of people in this world that unfortunately have been brainwashed into, getting a job, getting a degree, getting a safe position, paying down your mortgage, dealing with a whole bunch of student debt, and basically retiring in a position where all of a sudden you have to downsize and downsize again, and all of a sudden you're running out of money. It's a mess. So what I'm trying to do is I'm trying to really spread the ability for people to create and take care of their own financial future through building a small portfolio, 2 or 3 houses, nothing crazy, but that enables people to be financially set throughout their older years. So this for me it's a really big thing. So please do share, share on your socials, please do like, please do subscribe. I really do appreciate it. And not only that, it enables you to be able to receive the videos as and when we upload them as well. So that's kind of the entire section. If you've got any questions, please do ask any questions you have. Now is the time for Q&A. I'll give you guys a couple of minutes to ask any questions you have. If there is no questions, no problems, I will happily wrap it up. If you're catching this as a recording, and we're getting quite a few people checking out the recordings at the minute, which is fine. And if you're catching this recording, you've got a question, please do post the question in the comments, and I will more than happily respond and answer anything for you guys, personally, because I want to help. That's what I do. So, after coaching people for the last 7 years, I've kind of become quite accustomed to coaching and mentoring people through their property journey. So if you got any questions, do post it in there. I'm more than happy to. We've got a Q&A question. My apologies. I can't see the Telford deal on Trust Bricks. Oh, you should be able to, because I got it off the website. So let me see if I can share the screen. Bear with me 2 seconds. So new share. So here we go. So this is the Telford deal right here. So if you jump onto the website and look, if you're not already registered, that's fine. Just register on the website. It is absolutely free. There's no cost, there's no obligation. What it does do is it stops us being spammed by spam bots. And essentially, yeah, so you just register and then you log in every time. And then what it enables you to do is see the back end of any of the deals. So as an example, if I scroll on through, you'll see, so you've got a whole bunch of properties anyway. When you get to the bottom, you've got to give it a second and it will load through more. And you just keep on scrolling and you'll see there's a whole bunch of stuff in here. It is not listed in order that we uploaded, unfortunately. And we're creating some more filtering to make this much easier for you guys. Believe it or not, we have access to over 350 millions worth of property. So quite a significant volume of property. So yeah, so we're going to have to create better and better filtering. So we're slowly and surely uploading what we have available into the site. So you'll see there's more and more stuff coming available every single time you jump on. And it's varying in terms of discounts. So you get, anywhere between 5% discount all the way up. And you've got a couple that are no discount, but they are really good deals. So yeah, so they sort of make sense. Oh, yeah, you might just have to scroll a little bit further down because I know the reserve properties are showing up nearer the top, which they shouldn't be, but unfortunately they do. And there's nothing I can do about it at the minute. So our team's busy working on refining and improving everything as we speak. Oh, we've got quite a few on there. So I think I just saw it there as well. Just a second. So there we go. So Telford over here. So here's the property for Telford. If something comes up like this where the numbers don't quite look right, don't worry, it does happen. It's a technical thing. Again, we're busy working on the website. But yeah, you guys understand the figures, and just want to say thank you each and every single one of you for tuning in. For anyone that's catching this as a recording, again, thank you very much for watching, and I look forward to catching you on the next presentation next week. If you haven't already, do register to come along on Monday. So Monday evening, we're running a live face-to-face event. We're expecting anywhere between 50 and 100 people down in London, Marble Arch, private members club. We're going to be going through a whole bunch of off-market property. We're going to be going through a whole bunch of where you should be investing, what you should be investing in, what the best strategies are, all that sort of really juicy stuff as to what you really need to know. And it's our first big live event where we're going to be opening up to the public in years, actually. So it should be very interesting, very engaging. There's going to be some networking and also some free drinks. So enjoy a free evening with some free drinks and some cool networking and getting to meet some cool people. And of course, I get the opportunity to meet you guys as well, which is always a pleasure. So if you haven't already, do check it out. Go onto our website. Thank you very much, guys. Hope you have a great evening, and I will catch you hopefully on Monday. If not, then I'll catch you guys next week. Cheers. Goodbye.